Every month, the money leaves. You pay the car, you pay the card, you pay the loan, you pay the plan. And at the end of it, you have less than you should. You are not confused about math. You are not irresponsible. You are running inside a structure that was built to keep you running. And today, you are going to see exactly how it was built. Here is what nobody states directly. Affordability was redefined. It used to mean the price was within reach. That definition was quietly replaced with something else entirely. Affordability now means the monthly payment is small enough to approve. Those are not the same measurement. One tells you what something costs. The other tells you how long you can be extracted from. The entire architecture of modern consumer finance was rebuilt around that substitution. Nobody announced it. Nobody voted on it. The language just shifted, and the products followed. That substitution is the system. Everything downstream flows from it. You go to buy a car. The sticker says $28,000. The salesperson does not discuss $28,000. They discuss $399 a month. You compare $399 to your rent, your groceries, your other obligations. It feels survivable. You sign. What you think is happening is a reasonable decision based on what you can handle. What is actually happening is that the conversation was architecturally designed to make the total cost disappear and replace it with a number too small to trigger resistance. The term is 72 months. The rate is 9.4%. You will pay $38,000 for a $28,000 car. You never felt $38,000. You only ever felt $399. That gap between what you felt and what you paid is not a side effect of the transaction. That gap is the product. That is not a mistake. That is the model. Now here is where most financial content stops short. It tells you the car deal was bad. It tells you to negotiate better. It does not tell you why the structure exists in the first place. The structure exists because duration is the revenue. The longer the term, the more interest collected. The lower the monthly payment, the higher the approval rate. The higher the approval rate, the more volume moves through the system. Every incentive inside that institution points toward longer terms and lower visible cost. You are not being served by that structure. You are being harvested by it. Now, here is what the system actually targets. It does not target the broke. Broke people default. Default is unrecoverable loss. The system does not target the wealthy either. Wealthy people pay cash, retire balances immediately, and exit the interest cycle. They are low yield. The system is precisely calibrated for the band in the middle. Stable income, revolving balance, minimum payment current, no significant asset accumulation. That is the most profitable customer profile in consumer lending. Not rich, not broke, thin. Thin means you earn enough to keep paying, but not enough to ever fully exit. Thin means the balance stays open. Thin means the interest runs uninterrupted for years. The entire consumer product suite, the credit card, the auto loan, the buy now, pay later, the furniture plan, the medical installment, was designed and calibrated to locate that band, expand it, and keep you inside it as long as possible. This is not greed. This is incentive design. The model rewards duration. It does not reward resolution. Resolution ends the revenue. Duration extends it. The system does not need you rich. It needs you thin enough to keep paying indefinitely. Now look at what thin actually costs. An average revolving credit card balance of $6,000. Minimum payments at 18% interest. Over 30 years, that balance generates approximately $42,000 in interest. On $6,000, the balance barely moves because minimum payments are structurally calculated to extend the timeline, not retire the debt. You keep the card because it feels manageable.
The institution keeps the account because the math is extraordinary on their side. $42,000 from $6,000 across 30 years. That is the cost of not seeing the architecture. But the dollar number is not the full damage. This is the layer most people never reach. Every payment commitment you carry is a decision you already made about your future. You do not get to take the job that pays less but builds more if the payment stack requires the higher income. You do not get to leave the bad apartment, the difficult city, the deteriorating situation, if leaving creates a 3-month gap your buffer cannot cover. You do not get to negotiate from strength at work if walking away means the payments stop and the defaults start. Payment capture does not just extract money, it extracts optionality. Each obligation you carry narrows the range of moves available to you going forward. Over time, the accumulation of those narrowed choices becomes the shape of your life, not the life you chose, the life your payment stack permitted. This is not small. This compounds. If you are still evaluating every major purchase by monthly payment without calculating total cost, you are not making financial decisions. You are executing a system designed to prevent financial decisions. The structure replaced the decision with a feeling. The feeling is manageability. The reality is duration extraction dressed as affordability. Now look at 30 years across 2 positions. Position 1. You remain inside the architecture. Average auto financing cycle every 5 years. Average revolving credit card balance maintained. Average mortgage carried to full term. Across those 3 structures, the interest transferred over 30 years approaches $280,000. Not principal, not asset value, pure transfer, money that left your account and built nothing on your side. Position 2. You remove yourself from the capture stack. You eliminate revolving balances. You extend vehicle ownership past the loan. You build a cash buffer that absorbs emergencies without generating new debt. You redirect $250 a month into any ownership position, an index fund, a paid asset, anything that accumulates rather than services. At a conservative 7% over 30 years, that redirection produces approximately $280,000. The same number. One version you paid out. One version you built. The difference between those 2 outcomes is not income level. It is not financial discipline. It is structural positioning. One person stayed inside the architecture. The other one moved outside of it. Here are 3 structural moves, not tips, not mindset shifts. Mechanical repositioning. First, stop calculating by monthly payment. On every financed purchase, calculate total cost. Multiply the payment by the number of months and add all fees and interest. That final number is the actual price of the transaction. The system conceals that number because seeing it before signing eliminates many approvals. When you calculate it first, you stop being a payment approver and start being a cost evaluator. That is a different position inside the same transaction. Second, eliminate the smallest revolving balance first, regardless of interest rate. Not for mathematical optimization, for structural removal. Every closed account is one fewer automatic claim against your income at the moment it arrives. The goal is not just to reduce interest paid. The goal is to reduce the number of capture points drawing from your paycheck before you control it. When you close that account, that specific revenue stream stops. You are not budgeting. You are deleting a mechanism. Third, build a 3 to 6 week cash buffer before any other financial move. Not investment, not retirement contribution. Buffer first. Most people do not enter debt cycles from overspending. They enter from a single cash emergency meeting, 0 reserve. 1 repair bill, 1 medical charge, 1 shortened paycheck creates a deficit. Credit covers the deficit. The credit creates a balance. The balance creates a minimum payment. The minimum payment creates a new capture point. The buffer is not a savings goal. The buffer is the structural break that removes the entry condition the system depends on. When it exists, the recruitment loop cannot open. Each of these moves removes a mechanism. When you execute them, an institution loses a revenue stream. That is the correct frame. You are not improving habits. You are repositioning out of a structure that required your participation to function. Now think about what returns when the positioning shifts. The optionality that was suppressed begins to open. You can absorb a career transition without a debt spiral. You can take the risk that builds the better outcome. You can negotiate at work from a position that does not require the next paycheck to survive the week. You can leave the situation that needs leaving. The financial position changes, but what changes underneath the finances is range of motion. You get your future decisions back. And that is what the payment stack was always taking. You are not failing. You were positioned inside an architecture that was designed to feel like personal failure. The shame was a feature. Shame keeps you focused on your behavior instead of the structure. It keeps the design invisible. It keeps you optimizing your discipline instead of questioning the system your discipline is operating inside. Now, the structure is visible. The calibration is visible. The incentive is visible. The system does not change. The 72-month offer will still arrive. The payment language will not stop. The thin margin targeting will continue because the model still works on everyone who has not seen it. What changes is where you stand when it arrives.